Welcome to Stock Talk with Nico Criticos. Today we're going to be going through my bullish thesis on Arbor Realty Trust, and this is a stock that is a 8% paying dividend REIT stock, which stands for Real Estate Investment Trust. And the ticker on this company is ABR. I have a little bit over 100 shares of this company, and I have not bought in too heavily yet because the stock has been on a run over the past 2 years, and I'm kind of expecting some correction at some point. So I've been keeping an eye on it, and I plan on adding more shares when this stock falls 20 or 30%. So first off, we have the fact that this company has the majority of their assets in multifamily properties, and the CEO says that's the segment that's been growing the fastest, as well as their geographic concentrations are in New York, Texas, Georgia, California, Illinois, and Florida. And if we look up some of the best rated places to invest in real estate, we can see that places like Arkansas, California, Florida, Georgia, Idaho, Illinois are on the list. And a lot of those places are exactly where Arbor Realty Trust has been investing in. So that's a great sign. Next up, we have the management team. And I've watched several interviews with the CEO, Ivan Kaufman. And I think it's a great sign that he has been with the company for over 30 years, 35 years now. And he founded this company in 1983. And a lot of these other guys, the other executives, have 30 years plus of experience in the real estate sector. So that's also a good sign. And I think they've proven themselves in a lot of ways with the revenue and income increases they've had in the last decade. So next up, we're going to use my checklist to decide if this is a good stock to buy. And the first thing we're going to look for is if the stock is down or if it's oversold. And how we just saw, the stock has actually been up. So I would not consider this a dip or a good time to buy. I don't want to say it's not a good time to buy, but it's definitely has not been the stock's definitely not down. Then we have the revenue and net income increases. Over the past 7 years, it's been on a steady run. I would consider the price to sales and the PE to be healthy. A trailing PE of only 7, and the forward PE is probably somewhere around a 9 because their earnings are expected to fall like 10 or 15% next year. But revenue is expected to increase, I think, around 30%. Next up, we have, is the company innovative or do they have a moat? I put a no because I don't know a ton about the real estate sector, but I did read through their 10K, which is like 150 pages, and I can't really find anything that sets them apart too much. They do have different ways to make money, diverse product lines and stuff, and they bring that up a lot, but I don't know if that's enough to be considered a moat. So we're going to give that a no. Next up, is the industry growing? Yes. It looks like they've been doing they're good in their industry over the past 10 years or so, and the real estate market is expected to grow 6% next year. So then we have the fact that return on invested capital is only 2%, which is pretty bad. So that's also going to get a thumbs down. And profit margins are 53%. That is very healthy. So that's going to get a yes. And then healthy cash flow, I put no because this year was actually negative, and over the past 5 years, it's been very sporadic and all over the place. So that's going to get a no. Next up, diverse revenue streams. So they make money through loan originations as well as servicing and single-family rental homes, multifamily rental homes. And not only that, but they also said that over the past couple of years, no single loan or investment represented more than 10% of their assets, and no single investor group generated more than 10% of revenue. So that's also a good sign. Next up, the balance sheet. Well, they don't break down, they break it down in the 10K, but on Yahoo Finance, they don't break down long-term or short-term. They just say more assets and liabilities. So I gave a yes on both of those, as well as equity has been increasing. That's a good thing. And then the company has actually been issuing more shares, and it looks like it's for a good reason. They're using it to invest back into the business, which is good, but it still is also diluting shareholders, which is not good. And then their dividend is pretty healthy. It's between 7.5% and 8%. And then the payout ratio is only 55%, which is very healthy. And I think they said over the past 9 years, they've increased the dividend. So also a very good sign. Finally, we have, is big money interested? And yes, if you look up, I think there's lots of hedge funds that are buying into this, including, I think, BlackRock. And this is actually supposed to be 12 out of 16 of these criteria they hit. So this will be considered a buy since it's more than 10. And if we look at the positives of this company, we can see the valuation's cheap. Okay. Price to sales under 5, 4P under 10. Next, the company is founder led. That's always usually a good sign. And over the past 7 years, they have a nice track record of increasing net income and revenue. And then they said going into next year, supply is still going to be low for houses, and there's still high demand out there. So that should be good for a company like this. There should be higher prices, high demand. That's good. Also, dividend. How I said they have a high paying dividend, healthy payout ratio, and a proven track record of increasing that dividend. And then finally, if you look at, let's see, they're partnered with Freddie Mac and Fannie Mae. And if you look at their website, Fannie Mae's website, you can see there's probably 50, 10 to 20 companies in each of these categories that Fannie Mae partners with. And Arbor Realty Trust is one of those companies in a lot of these categories. So whether you look at, let's see, if we look at affordable lenders, if you look at seniors housing lenders, you can see they're not on this one. They're on some of these other ones, but that's just, it's a good sign to know that Arbor is associated with those companies. And then we have the risks and the cons of this company. And that is, for one, their unsteady cash flow. So how I said earlier, the cash flows are not healthy, the free cash flow or the operating cash flow, because you can, the end cash position has been increasing year over year, which is good, but look at their operating cash flow. It's gone. So this is in the past year. Okay. But it's just, it's negative, and it's, they've had some positive quarters, but then it's, Q3 of this year, they lost $727 million. So I don't know. That's not a great sign. I don't really like that. I'd rather see some more consistency, but that's a small problem. Then we have interest rate hikes coming in next year. That could potentially slow down the real estate sector. We'll see what happens. It's also going to depend on the supply, and if commodity prices go down, if people start building houses again, that's going to be a big factor too. Then we have the fact that the Fed said a couple of weeks ago they're going to speed up their reduction of asset purchases, and that means there's going to be about a $10 billion reduction per month in mortgage-backed securities. And so that's not a great sign for the real estate sector. And then finally, we have share dilution. How I mentioned earlier, the share change year over year has increased 25%. That's not good. I mean, it's good in the sense that maybe they're raising money to invest back in the business, and that's going to help them, but it's bad that they're diluting shareholders. So a couple different things to consider, and that's pretty much it. I mean, I like this company I think it's a low valuation, a proven track record of growing revenue and net income. That's one of the most important things. It's founder led. He's been there for 35 years. And I don't know, I think maybe next year they have a tough year. Maybe the interest rate hike and, some other things get in the way and it slows down the real estate market, but I don't think it's going to last long. So I think this is a good company to be in. And that is all. I mean, I think if my cost basis is like $18, if it falls to 14 or below, then I'll probably buy a lot more shares. So yeah, I'm curious to know what you guys think. Comment down below if you're going to buy this one. I'm not a financial advisor, but I hope the information here helps you guys. And yeah, I'll see you in the next video.